I had to say there's one chart that's more important than any other chart, including S&P, NASDAQ, gold, silver, any of them, it's this one. What it shows is gold, ounce of gold, using front month COMEX contract, divided into the S&P price, okay? And you can see back in 2011 through 13, especially in 13, which is where this chart starts, gold was collapsing in price also against the S&P. It was losing value to the S&P. And when gold bottomed in late 2015, that spread reached down to about 50%, that first little circle you see there. And at that point, you can go sideways for 10, 11 years now, and it's been above that level and below that level, but basically par to the S&P. In other words, it's, depending on the point in time you pick, it's doing better or a little bit worse than the S&P, but basically going sideways, okay? Meaning it's not really been as bad as people think. And it's not just recently that gold's firmed. It's at the upper end of the 11-year range right now. But this thing has built a technical base that is so clear it smacks you in the face. It's hit 1, 2, 3, 4 times as of April this year. You bumped that line, backed off again. You're back pressing at it right now. In fact, you're above it intra-month. This is monthly closes, so gold into the S&P. And you close the month where you are now. Divide gold into S&P, it's going to break out. What does that mean? It means that this is a fresh, massive technical base breakout. Treat it as a price chart. If you looked at this and saw it as a price chart, you say, oh boy, I'm going to get on board. And I'm going to buy. Well, this means buy gold, sell S&P. In fact, you want to go market neutral, buy gold, sell S&P. You put a spread on. But it's also telling you that gold is going to surge versus the S&P. Now, by the way, when we do this same chart, we didn't have it in this report, versus the Dow, or gold versus the New York Composite, both very broader indexes that aren't front-end loaded with a couple of AI stocks like the S&P is. Gold's already broken out. But when this guy breaks out, this spread breaks out, it's telling you as a major asset class shift is underway, it's commencing. Gold is now going to outperform the S&P. So if you invest over spans of time and want the better asset class, it's saying gold is going to lead the S&P now. It's the better place to be. And our assessment is, one, it's going to be the consequence of two things: gold going up and S&P going down. Okay. So this is our table pounding technical chart to nail you all. If you're in the stock market or the gold market or wherever you are, this is the most important breakout that's about to occur. And if it breaks out, which it will, this is too persistent, okay? It's saying, I just began. So if you think gold is old, it's just begun its major shift against the paper bubble, the U.S. stock market. Just began. It ain't gonna end in 3 months. This is something going on for years. So don't think of gold as being at the end of something. It's just beginning when you measure it versus the U.S. stock market. And again, it's already broken out versus the Dow or the New York Composite. It's about to break out versus the S&P. So this is a very important investment grade technical chart. I think this time around in the major markets of the world, gold being one of them, the monetary metal been around 3,000 years, silver as well, that the ongoing process we've had for about 100 years now, one long human lifetime only, of the Fed, one, have a monopoly control over the quantity of money and a monopoly control over the pricing of money, okay? Now, if you had that over, let's say, the price of corn, and the government said, okay, corn's essential, we're going to take control of that market, we're going to determine the quantity that's produced every year and the price we're going to sell it at. Well, people would say, well, that's socializing the ag industry. It's what Mao Zedong did. They gave that up in the 1980s in China, by the way, and they privatized. But nobody comments on that. It's an inefficient way for the most essential commodity between human beings when they make a transaction, whether they know each other or they're separate parts of the world, to be distorted by a central bank. Well, if that is not causing good effects, boom and bust cycle after boom bust cycle, and it's going on in Japan as well and in Europe and so forth, there's a point at which people finally say, hey, I had enough of this. It isn't working, especially if you inflict pain on them. And I think if you take that stock market down, and we think it's in a topping process, it has been since early this year. New highs don't change that. Our momentum work says momentum is peaked, price is waiting, it usually lagged the momentum. But if that guy goes down and you start to get the wave effects in the real world, like we did 2007 to 9, if you'll recall, people that weren't even in the stock market were hurt badly. You inflict pain, people are already hurting, we know that. Consumer credit's maxed out, the number of card delinquencies is exploding, failure to file tax returns, et cetera, et cetera. You take that market down and the real world consequences get worse, you can have people throwing their arms up in the air saying, gee, neither party seems to work. What do I do? And that's when academicians come in, and they have influence because they often are brought into the government as well. They'll say, hey, this central bank thing, this hasn't really been working like we thought it would. Instead, it creates boom busts. So you could end up with a situation this time around where gold goes up and becomes monetized, silver with it, where suddenly you go to a new price level, not just because of industrial demand for silver or anything like that, or repricing it out of an old reality into a new reality. We can get onto that in a minute. Where bigger decisions are made such that when gold goes up next time, all of a sudden this country, that country, that country, that country, no more fiat currencies backed by real stuff. And that could be the outcome of this move. So this stock market move, this gold move, commodity move, all the things we can talk about here shortly, could be different this time. They're likely to be in terms of significance. I'll give you two examples. You only have 50-year history. The U.S. government legalized it, okay, in January 75, okay. Over that time, there have been two major bull markets. And if you measure from the bear low that preceded the bull market to the bull market peak, bear low to bull peak, both moves, one peaked in 1980, one peaked in 2011, were 8-fold moves. Not the same dollar amount, but the ratio move. The same dimensionality of price gain, 8-fold, bear low to bull high, okay. We're only 4-fold. We started from a bear low at 1,050. Multiply times 4, okay? You're a little bit better than half the dimension of those two prior bull markets, which were of different duration, by the way. One was about 3.5 years, one was about a decade, okay? So I'm not counting the years, I'm just saying how much did it move? And it moved under circumstances then that are by no means as dynamic pending as the ones we're sitting on right now. So I expect gold to go to 8,000. That's just matching the old highs, though. That's not even abnormal. That's like saying, I did it again. How about we go a lot further than that? Don't be surprised. Like 20,000, whatever. Again, it's going to depend not on so much the technical dynamics of gold when you do swing measurements or anything like that. It's going to be on these other factors that suddenly cascade into play. All kinds of factors like that. But as far as I'm concerned, just as the U.S. government and their central bank, just like the EU and Japan, don't control reality. So even if they set a price, I don't care. It doesn't mean it's going to stop there, okay? They don't fix price. They may try to. I mean, there's some solid arguments that they've been manipulating silver. We need to get onto that too. And capped it off for the last 50 years. While copper and lead have quadrupled. I'll get into that in a second. And suddenly I think silver is about to leave and overrun that attempt to control the price of silver. And we know some of the big banks have been manipulating silver. In fact, there's been a couple actual criminal convictions in that regard. But if you want to, we can get on to that next subject. And you've got the spread chart of silver versus gold.
Silver versus gold.
Yeah. Okay. Now,
what's happening here?
This only goes back to 2020. Okay. So 5 years. We know in early 2020 into late 2020 and early 21, silver exploded in price. And therefore, the spread chart showing an ounce of silver divided into an ounce of gold was under 1% then. It was under 0.9%. Divide an ounce of silver, an ounce of gold. It shot up to over 1.5%. That's a huge percent gain. It's like buying a stock at under $9 and it goes over 15. Did it in like 6 months. These are weekly readings here, by the way, week to week. But then since 2021, when silver was over 1.5%, which is still dirt cheap historically, silver to gold, it eroded. Now, price of silver is going up since 2020. We know that. 2020 was 30. We're now, $52, 53. So it's gone up, but its performance versus gold has eroded, meaning it's not gone up as much as gold from that point to the current level. Now, you'll notice since about March of this year, that thing exploded back up again. So silver's been outperforming gold for the last half a dozen months or so, gaining. But there's a green line on that top chart, the spread chart. If you can clear that line, this spread breaks out, and that line goes back over 3 years. Ceiling, ceiling, ceiling. It's called what you call a base, okay? You break out over that, it's a fresh buy signal, meaning time to buy silver rather than gold. Doesn't mean gold's going down, just means silver's going to beat it. So if you have the combination of that first chart, gold breaking out versus the S&P, what it's telling you is you want to be in monetary metals, not the stock market bubble. This chart says you not only want to be in monetary metals, you want to be in silver as opposed to gold, because it's going to beat gold. I'm strongly of the assessment that when that first chart breaks out, gold versus S&P, as I said, it's already broken out versus the broader stock market indices. Silver's going to break out versus gold. And already this spread chart doesn't show where it is right now. It's up. It's moving up toward that green line right now. This chart's a week or so old, and we know a lot has happened in the last week. So that's another spread I'd watch, because it's not only telling you monetary metals are a place to be, but now you really want to focus on silver. Now, where might it go? If you go back 50 years and measure the peak point of where silver was versus gold each of those years, what was the highest rate, percent level, ounce of silver? 20 of those 50 years, it was at 2%. And some of those years weren't even bull years. In fact, the bull years, 1980, 2010, 11, silver was up to 3.5% and more the price of gold. But just routinely, 2% is not uncommon, 20 out of 50 years. Well, heck, right now you're at 1.27% as we speak. If it went to 2%, just a norm, well, that's a huge move. That's almost a doubling of the price of silver in relation to gold. So anyway, this is an area where I'm mostly focused personally in my investments, and they're exposed at the end of each report. I disclaim what I own. All my emphasis is in silver, sometimes silver calls, silver miners. This sort of reflects what you saw in the silver gold chart. Back in 2020, you had this surge where the silver miners beat the gold miners. It's like buying a stock at about $96 and it goes to 135 in 6 months. The spread went from about 96% to about 135. Divide the price of SIL, the miners ETF, into the price of GDX, which, by the way, does hold some silver miners, but it's primarily gold miners. But since then, even though SIL and GDX are now above, have advanced, and they're above that 2020 price high, the spread is not, meaning the silver miners have sort of gone sideways on the spread chart back to 2022. I've got a little black line there on the top chart, horizontal line that shows that they've oscillated either side of sideways since 2022. So for 3 years, basically the silver miners haven't really underperformed, but they haven't outperformed. But there's a structure, that green line, that's been hit 4 times since 2022. So it's a clear structure. You close a month out above that green line, and right now we're pushing to do it. Current levels, reading of silver versus GDX. Then not only is silver breaking out versus gold, but the silver miners are saying, I'm breaking out versus the gold miners, which would echo what we're arguing is likely to be the case, silver versus gold. So my emphasis among the miners now is to buy silver miners as opposed to gold miners.